proverb about wealth that says it goes from shirt sleeves to shirt sleeves in 3 generations. Statistically, it is remarkably accurate. Roughly 90% of wealthy families see their fortunes completely vanish by the time their grandchildren take over. If you look at extreme wealth from the outside, it's easy to view it as a static pool of cash. The traditional public assumption is that you simply park the money in standard markets, collect the passive interest, and the fortune sustains itself. But the modern age of upheaval has shattered that passive strategy. This line chart shows the performance of a classic 60-40 portfolio, 60% equities and 40% government bonds. For decades, it was a reliable baseline for safe growth. In 2022, however, the returns on that classic portfolio plummeted, delivering its worst real terms performance on record. Yet external economic shocks like that are rarely the actual reason a dynasty falls apart. By the time a family's bank account starts dreaming, the real damage has already been done. A shrinking balance sheet is just a lagging indicator of a much deeper problem. True wealth destruction begins internally. The core structure of the family starts to rot, fracturing alliances and eroding competence, long before the financial ledger ever hits zero. Inheriting a standard savings account is simple. Inheriting a billion-dollar estate is like inheriting a sprawling, multinational corporation. It comes with extreme legal liabilities, complicated tax structures, and interlocking dependencies. We have to look at these estates through the lens of systems theory. If a single non-financial node in a family network, like internal trust, an heir's individual competence, or a set of shared values, snaps, it triggers a cascading failure. The stress ripples outward, and eventually the financial node crashes under the pressure. The 10% of elite families who manage to break the 3-generation curse do so by engineering anti-fragility into their family dynamic. They build a system that actually grows more resilient when exposed to stress and volatility. To survive the modern era, the ultra-wealthy must move beyond treating their fortunes as a buried hoard of gold. They must engineer their own families with the structural rigor of a multinational conglomerate. This infographic outlines the exact architectural framework utilized by elite wealth managers to map out this ecosystem. It is called the 4 pillars of capital, and it rests entirely on a foundational block labeled purpose. Looking at the blue pillar, financial capital involves the tangible assets. Modern old money is shifting away from volatile public equities and prioritizing private markets, focusing strictly on capital preservation over aggressive growth. The purple pillar is intellectual capital. This is the mandatory transfer of financial literacy and psychological preparedness to the next generation. Giving a young heir massive wealth without the competence to manage it is toxic to the system. Next is the light blue pillar, social capital. This represents how the family interacts with society. Managing public reputation and minimizing political and regulatory risks is the structural driver behind the modern trend of quiet luxury, wealth that intentionally avoids drawing attention to itself. Finally, the green pillar is cultural capital. This is the shared family mission, the gravitational force that keeps the family tree from splintering into entitled, competing factions. As you can see, all 4 pillars require that unified foundation of purpose to stay upright. These pillars are highly interdependent. If a family experiences a structural failure in its culture or its intellect, the eventual collapse of its financial capital is guaranteed. Which raises a logistical question. Who is managing this complex, multi-pillar ecosystem on a daily basis? This report highlights the answer. It's the family office, a rapidly growing, unregulated shadow financial sector dedicated exclusively to maintaining these private dynasties. Looking closer at the text, the sheer scale of this hidden sector is massive. Family offices control an estimated $6 to $7 trillion in assets, roughly double the size of the entire global hedge fund industry. Family offices operate as governance councils, educators, and strict process managers. Just as Atul Gawande argues in The Checklist Manifesto that rigorous procedure saves lives in surgery, family offices use checklists and formal mentoring to eliminate systemic error within the family system. They function as the dedicated immune system of old money, engineered to ruthlessly diagnose and treat generational decay before it takes root. When a billionaire dynasty is successfully managed this way, it stops operating like a traditional family. It functions more like a highly coordinated, perfectly private mini-society. As these family offices successfully apply the 4 pillars to shield their clients from taxes, volatility, and internal decay, they actively extract and sequester massive amounts of capital from the broader global economy. By utilizing dynasty trusts to sequester wealth and bypass estate taxes, these systems ensure that assets never cycle back into the public market. This successful preservation of all 4 pillars effectively locks multi-generational wealth inequality into the global structure. Sustainable preservation requires the continuous, meticulous engineering of human behavior, purpose, and capability. The fortunes that manage to survive the modern era do so for one specific reason. They build a rigid system where the family's shared competence outlives the founder's original money.